One of my first dividend stocks in my investment journey was actually Rowe Price, stock ticker TROW. Year to date, they have performed quite nicely. And as you can see here, in general, asset managers, assets under management has actually also performed so far really good in 2023. You can see Rowe Price up around 10%, roughly the same as a big company like Invesco. Rowe Price actually released their earnings last week, and as you can see here in the news bulletin, the non-GAAP EPS of $2.02 was actually beating the estimate by 29 cents, so quite a huge beat on that regard. The revenue of 1.61 billion grew 6.6% year over year, and that beat the estimates by $20 million. This earnings report actually made the stock price surge. As you can see here, it went up 8.27% before close. Over the week, it's up 5%, and if we zoom out year to date, they are up around 16%. Over the last year, they are up 5%, so it's actually been performing quite nicely. One of the alluring things with Rowe Price is the dividend. You can see here the dividend yield 3.85. The payout ratio sits at 66% right now. 5-year growth rate of over 13% and the dividend growth streak of 36 years. So now as you can see here on the dividend history, consecutive years of dividend growth 36 and consecutive years of dividend payment. So they have actually been growing the dividend every year since they started to pay out. Rowe Price actually performed quite nicely compared to SP 500. You can see here on the graph that it actually followed quite a bit until around mid 2021, where actually Rowe Price started to take off compared to S&P 500. Then we get to the start of 2022 when the war in Ukraine started and inflation started to rise, and then Rowe Price just bombed completely, and ever since it's starting to try to catch up to S&P 500, but are still lagging quite a bit in total return at least. Jumping a bit into simple safe dividends, you can see here on the graph on the left that the dividend yield is indeed above the 5-year average. According to dividend yield theory, that could indicate that the stock may be undervalued, even though the forward PE ratio is above the 5-year average. This could probably just indicate that the expected earnings are in a transient dip right now. Simple safe dividends are giving Rowe Price a rating of 80, which means that the dividend should be safe, as you can see here. It pays out quarterly in March, June, September, and December. And as you can see on the payout ratio graphs here, they are indeed a bit high right around now, because as I say, below 50% is the preference for asset managers. But as you can see on the history here, they do have a strong history of being below that 50%. So I think it's mainly coming down to the macroeconomic environment right now. So I believe in the future that Rowe Price will get this back under control. Even though the last raise in dividends was quite small, 1.7%, they do have a strong history of high dividend growth. As you can see here, over the last 5 years, 16%, and over the last 20 years, 14% per year, giving a rating of very fast by Simply Safe Dividends. And as you can see here, the annual dividends per share is how we want it to be, up and to the right. Rowe Price are also giving value to shareholders by decreasing the shares outstanding. As you can see here, they went from 266 back in 2013 to 225 in the last 12 months. Also, the revenue is growing. You can see here they did have a very great year in 21, and again, due to the macroeconomic environment, they did drop down a little bit back in 22 and during the last 12 months, but I believe in the future they will be back up again. Rowe Price are also seeming to be capable of delivering quite steady returns. As you can see here on return on equity and on return on invested capital, both to be above 25%. Again, due to the macroeconomic environment, the last couple of months here are not looking that great, but otherwise we want to take a look at the history where they do have a history of delivering above average returns. I would say you can see here return on equity are steadily rising, 32% back in 21, and also return on invested capital are steadily being in the 30 to 35 range. And then we have one very good year back in 15 where it actually touched 40%. Margins are also looking extremely good. You can see here that the operating margin are usually in the 40 to 50% range, even though they dipped down to 32% during the last month. So still quite nice of a profit they are making. Free cash flow margin also pretty steady in the mid 30s range. And one last thing I really want to see is how they are handling having debt. And as you can see here, Rowe Price, the net debt is 0 basically. So they do have more cash on hand than they do have debt. So for interest coverage, not a problem. Net debt to EBITDA, not a problem. Net debt to capital, not a problem at all for Rowe. They have plenty of cash on hand. Rowe actually has an average price target from the analyst of just shy of $100, meaning a potential 21% downside from the current levels. And as you can see here, the analysts from Wall Street are actually classifying it as a sell right now, where we do have 7 analysts has it as a hold, 4 has it as a sell, and 2 has it as a strong sell. But T. Rowe Price is actually one of my favorite dividend stocks, so I also wanted to calculate the intrinsic value based on my spreadsheet I've used numerous times so far. And as you can see here, we start with our stock screener, where we do have a lot of the metrics that we have just gone through, and we will use a lot of these to actually calculate the margin of safety when we get to the summary. So let's jump into it right away. As you can see here, we do also have our dividend data tab. So if you zoom in a little bit, what we really want to see here is steady rising dividends. As you can see here, we did have the little bit of a blip down here in the last one, but other than that, it's looking quite steady. We do have a lot of different valuation models. The first one being the dividend discounted cash flow model, where we do take some of the cash flow from the years. We then use that to project some future free cash flows. Using that, we can calculate a fair value from the stock. Also using the dividend discount model, where we do take dividend payout, using those combined with the weighted average cost of capital, we get an intrinsic value. Multiples valuation, where we do compare T. Rowe Price to a lot of its peers, and then we can calculate a stock price and intrinsic value based on that. We do also have the price to earnings valuation, where we do take the average PE ratio from the last 5 years. We can then calculate using the EPS and intrinsic value based on mean reversion theory. Also Graham's revised valuation model, where we do take all the different parameters in the formula on the left to calculate an intrinsic value. Next one is the free cash flow valuation, similar to the price to earnings ratio, where we do take the price to free cash flow ratio. We then use the free cash flow per share to calculate an intrinsic value as well. Last one is the Peter Lynch model, where we do take the Peter Lynch formula and use the different parameters to calculate an intrinsic value for T. Rowe Price. Before we jump into the summary of all these models, thank you so much for watching, and if you haven't done so already, please subscribe to the channel and like the video. Now let's jump into the summary, where we do have all the different valuation models that we just saw before. I do want to exclude some of them. As you can see, the dividend discount model is negative due to the growth being so high, so let's take that away. I do also want to take away the Graham's model, since the negative growth from T. Rowe from the coming years, probably due to the macroeconomic environment, are obscuring the results a little bit, I believe. So if we take that away, and also Peter Lynch model, same reason, due to the growth rate being so low as it is, I also want to exclude that one. That gives us an average intrinsic value of $121, with the current price being around $126. So right now it could indicate there's a bit of a premium, but we do also have our margin of safety calculator here on the right. So we start with a standard of 25, and due to some of the key metrics that we saw earlier, such as the EPS growth, return on invested capital, payout ratio, and so on, we do calculate a margin of safety of this. And as you can see here, it actually ends up giving us a margin of safety of 0. So according to at least to all these metrics and this spreadsheet here, it actually just should be a 0 here, which could indicate that the average current discount right now should be sufficient. So as you can see here, the spreadsheet thinks that an acceptable buy price is $121, a bit below the current price of $126. So if you're interested in the stock, it could probably be a good entry point right now. As Warren Buffett famously said, it's much better to buy a wonderful company at a fair value than a fair company at a wonderful value. So I do believe we are close enough to the correct price right now to be a very good entry point. I am personally quite heavily invested in T. Rowe Price. So for me personally, it's a very, very nice company, and I do want to hold it and add to it for the coming years. If you do want to have a bit of a margin of safety, I would wait a bit on a drop, because it could probably come within the next couple of weeks. Ever since the stock price surges as much as it did last week due to the earnings report, they will probably be trimmed a little bit here and there, and then the average price will probably get down a little bit again. Other than that, you could obviously also use a small margin of safety of, let's say, 5%, which would give an acceptable buy price of $115. Let me know down in the comments if you are owning T. Rowe Price or if you are thinking about it. Please like the video, subscribe to the channel, and I'll be seeing you in the next video. Thank you so much for watching.